Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. So I'm really excited for today's episode as I have an award-winning portfolio manager on as a guest who is an industry leader in the small cap space. The small cap space has been under fire in recent months, so the timing of this conversation I don't think could be better. And he's going to provide some great insights into the small caps moving forward. So with that backdrop, I think you all will enjoy today's guest and learn a lot, as I know I'm going to, and I'm sure it's going to be a very engaging conversation. But first, today's episode is sponsored by award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. So enough about me. I'm going to want to go ahead and introduce and welcome Jon Christensen. Jon is a portfolio manager at Kayne Anderson Rudnick. Jon has been with Kayne Anderson Rudnick since 2001 and manages the firm's small cap core, small cap sustainable growth, small mid cap core, and mid cap core strategies, which have all been named as a PSN Top Gun numerous times over the years. Jon has an MBA from California State University, Long Beach, and a Bachelor's of Science in Mathematics Applied Science from UCLA. Jon is also a CFA charter holder. Jon, thank you so much for being on the show, and congratulations again on being named a PSN Top Gun numerous times across all the strategies you manage, most recently during the first quarter of 2023. So thank you, Jon. And let's get started by just telling us a little bit more about yourself that might not be included in the bio above.
Sure, Ryan. It's great to be here. Thanks for having me, and I look forward to our discussion. So a little bit, more about me. Obviously, coming up on 22 years. I'm a graduate of UCLA. Had the opportunity while I was there to hear John Wooden come and speak at our school a couple of times, and obviously take away a lot of his knowledge, not only for life but investing as well. It's amazing how that can apply to a lot of different things. I just personally am a huge baseball fan. I have around 20,000 baseball cards, which we can talk about a little bit later if you'd like. It's very nostalgic for me, and I continue to enjoy that hobby well into my years today. I won't say later years, but years today. So it's something that I really enjoy, and so
That's awesome. Yes, I would love to talk a little bit more about that baseball card collection. I don't have nearly 20,000 cards, although my mom, every time I talk to her, she asks me when I'm coming home to get my baseball card collection in the boxes that are stored underneath the bed. So that's fantastic. So, and also with UCLA, we're friends now, but once UCLA becomes part of the Big Ten and my beloved Wisconsin Badgers have to play UCLA, maybe we'll have you back on the show to talk a little football and basketball.
That's gonna be a challenge. A good challenge for those West Coast schools to go back east. It's gonna be interesting to watch.
Yes, especially come November. Let's see how UCLA and USC fare in Madison in November. So fantastic, Jon. That's great. As I mentioned at the opening, that you are a portfolio manager for numerous small cap strategies. In addition to being a small cap manager, what's your investment philosophy?
So, basically, we're a concentrated small cap manager, and people immediately associate both of those characteristics with higher risk. But when you look at our numbers, it really doesn't bear that out. We're trying to deliver superior returns of the asset class with less risk, given the criteria I just laid out. So our focus is on high quality. I understand quality is one of those terms that's laid out there. A lot of people say they buy quality. For us, quality really is a business characteristic. Okay, we want to find companies that can grow, protect, and nurture a market over long and multiple economic cycles. That last part's very important. It's great to find companies that do well during good times. We really want to find companies that hold up well during difficult times. because we believe that by mitigating your downside, you enhance your ability to compound over long periods of time. So
Mhm.
for us, finding those companies that have that competitive moat that can, again, grow market share during those good times, and while doing so with a low capital intense balance sheet and cash flow. So usually our companies have less debt,
Mhm.
lower fixed costs in terms of their P&L. So that's how they're able to really maintain profitability during these difficult times. So again, we believe just by having a concentrated portfolio of 25 to 35 names of those types of businesses, you should be able to create overall a portfolio that should have those characteristics I laid out earlier.
That's fantastic. And when you have a smaller portfolio, I believe you're probably have higher conviction in those names,
Right.
right? You're more confident in those names versus having a broader portfolio. You can provide more alpha. We are a firm believer here in just, about downside risk metrics, capital preservation, especially during times like this that are so uncertain moving forward. There's that wall of worry seems to grow by the day. Granted, the debt ceiling crisis might be removed from there, but still, downside protection and in limiting drawdowns is very important. So such a interesting investment philosophy there, and thank you so much for sharing. So markets, as you said, they evolve, they change. Over time, markets move quicker than ever, and different investment styles, whether it's the growth versus value argument or sector rotations, move in and out of favor quicker than ever. So how do you stay true to your investment style, focusing on quality small cap names during different market environments, especially when maybe your investment style may be out of favor, like during the pandemic when you had all these fear of missing out, and you had AMC and GameStop going to the moon, right?
Yeah.
For whatever reason. How do you stay committed to your investment style?
Yeah, no, that's a great question. I think that's really important to remember, and you brought this up a second ago, Ryan, is the conviction. Okay, so you're right. We have these concentrated portfolios. That means we have to have high conviction. That means we got to do our work,
Mhm.
right? So we have to do our due diligence on these companies. And by the way, we have very low turnover in our portfolios, only like 20%, and that's including trim. So we don't need a lot of names to populate the portfolio. But we want to make sure we get the good names, and we spend time understanding these businesses structurally. And I'm going to get back to why that's important in different market environments, but structurally understanding these businesses, because all businesses are going to have problems from time to time. The question is it transitory, or again, is it structural? And if you don't understand a business from the ground up, you aren't going to know the differences, frankly. So for us, it's about doing a lot of work on these companies and having that conviction, as you talked about. And this will allow us to and sustain us our confidence, given what you just talked about in terms of the markets. Now, right, there are different market environments where we will outperform, and there's market environments we will not outperform. So given kind of what I talked about earlier, let's just take through different scenarios. If you have more recessionary environment,
Mhm.
we should outperform in that market because of the high quality nature that I talked about before of our businesses, right? They should hold up better due to their business model, that competitive moat, that capital
Mhm.
structure that they have. When we're coming out of a recession, the market's embracing speculation, the market's embracing risk. We typically don't outperform in those markets because, frankly, our stocks didn't get hit as hard, so they're not usually going to have that trajectory back up. We're okay with that. Third market is kind of more of a benign GDP environment where the Fed, for the most part, staying out of things. We should outperform in that market as well because we have high ROE companies with trading at reasonable multiples that are outgrowing their markets. So I think the thing is that, two or three of those markets, we kind of like our chances, right? And there are opportunities even in low quality markets where we can outperform through stock selection. So here's the thing, though. I think this is important because people say a lot of times, well, why can't somebody just take what you're doing and just emulate it, right? Just copy it. And I think the
Mhm.
thing is, we're human beings, right? And when we're trailing, for example, we're in a market where we're trailing. What's what's our intuitive, and what as human beings or as companies, what do we do if an athlete's is on the free throw line, can't make free throws? What do they work on their free throws? Or maybe I'll try a different stance. I'll try to throw the ball this way instead of this way.
Yeah.
A baseball player, I'll change my batting stance if I'm in a slump, right? So that's what a lot of investors do, right? They say, well, I'm trailing, so let me go out and maybe I'll start buying these types of companies because those are the ones that are hurting me now. So they're kind of chasing performance, right? Like, for example, for us, we don't own a lot of energy companies. We don't own a lot of utilities because they're highly capital intense, they're highly levered, some of them are highly cyclical. But there's moments where they're doing well. 2022, energy markets had a great year, right? That worked against us.
Yeah.
But that does not mean we're going to go out now and buy energy companies, right? Because it goes against who we are as investors. So, when we're underperforming, are we happy? No. But do we understand it? Absolutely. And that thing goes back to what I'm talking about. We will not pivot who we are as investors to go after that performance. Do we look for opportunities of good businesses that maybe they have gotten hit hard in a sector that maybe don't reflect the same issues as the others? Absolutely. We think that's when we find some of those gems. But there are just some structural businesses out there, like again, in utilities and energy, that we will just not go into no matter how well they've been outperforming. So I think that really is, that consistency that we supply is really what's allowed us to have the success we've had is the acceptance that, hey, there will be times we'll underperform. That's okay. But we'll just keep our, head down and just keep investing the way we are. And we know eventually things will come our way. And that's happened, for many, many years. And that's why you see the numbers that we have. The consistency, right? It's the same thing with businesses, right? Businesses that we invest in. Do we want to see them, doing what they do best or going into new businesses that may be kind of iffy? That's what happens with a lot of that. We can get into that, maybe the sell discipline later, but that's usually what happens. Businesses sometimes don't get content. And they're always wanting to grow more and faster. And that means usually compromising their core business. So again, that's what we want to do. We want to stay with our core business. And we want to evolve, obviously, in how we look at businesses, but we also don't want to pursue things that we think will be dilutive to returns over time.
That's fantastic. And the numbers show that your style, your philosophy at the front, it works. It is, and it works consistently. Like you said, it is so important. We've done studies here at Zephyr that, consistency pays off, right? You want to be consistent. It helps investors, your clients, sleep well at night. You mentioned a lot of stuff that, you talked about your turnover rate, but it's so important to know, and investing is so behavioral now, right? As an investor, when do you buy, when do you sell? Or, is this a security that was passed down by your parents? Or it's so behavioral. To know who you are as an investor is so important, and then know who you are and stick to who you are, right? Don't try and chase returns. That type of investment strategy is long gone, right? And it tends not to work very well. But you talked about your turnover ratio as being very low at 20%. So that kind of goes into my next question about your sales strategy. Sure. Obviously, you don't sell very often, but what is your sales strategy?
Sure. No, great question. I personally think, Ryan, that this is just as important as buying, right? Because let's face it, you can make mistakes when you sell something and it keeps going up. That's a mistake, right? Or and that's just as important as buying something that goes up or goes down. So I think it's very important. I think the main reason, about 95% of the time we would sell something, is what I just kind of alluded to earlier. It's something the company was going along very nicely and they pivoted. And that could be through their own doing or organically, or most of the time it's through acquisition. So we're not, we're not anti M&A, but we're also not hugely pro M&A. So we're very meticulous in analyzing companies that do a lot of M&A, because as you know, companies can go out there and they can overpay for something. They can buy a company that's not as good as the core business. There could be integration risks with that, right? There's a lot of things that go wrong. So that is usually the main reason we would sell something. Is this great business is going along and all of a sudden it's turning into a different business. And again, it can happen through M&A or just sometimes just evolves over time. Occasionally, one of our stocks gets taken out by a larger company. Frankly, that doesn't really happen that much.
Mm-hmm.
People always ask us, well, if you have such great companies, why don't your companies get bought all the time? And I say, I'll rebuke that with, well, name the companies that usually get bought. They're usually not the best businesses. They're usually businesses they kind of need. Or maybe have one product. They need somebody to come in and help them and enhance their sales. There's something going on there. So it's usually not the best businesses to get bought. So we're okay with that, right? By the way. So remember, if our stock gets taken out, then we got to go find another great business. We'd rather just own the business we have and let that one take us through it over time. So those are the main reasons. Rarely do we sell anything, Ryan, based on just only valuation.
Okay.
Because we need something structural also have a headwind to it as well, because valuation can be very tricky. It goes back to what we talked about in terms of, we want to make sure we're not just selling our roses and sowing our weeds, right? So that's why we want to make sure that when we're trimming or selling something and the valuation is high, well, maybe the valuation is going to go from 30 times earnings to 35 times earnings. So that's what I'm saying. When you sell something that keeps going up, that's just as bad as buying something that goes down. You've missed that opportunity. Yeah. So that's why for us, we want to make sure that usually the valuation is being married with a fundamental headwind that would maybe create us to sell the whole position. Usually if it's a valuation only, we'll probably just trim it.
Interesting. We reference, talking heads, valuations and PE ratios all the time, right? But I'm getting the sense in the marketplace, professionals maybe aren't using valuation metrics as much as they used to. Like you said, there's some issues with valuations, and in a lot of time, nothing against the retail investor, but with the growing retail investors, and you have behavioral investing, it can drive up the price for whatever reason, right? And it's not due to the fundamentals. So I'm seeing less and less people focus on valuations more recently. So great information there. And my next topic, I don't want you to give away your secret sauce here, but as an active manager, you have to believe markets are inefficient. And that is very true in the small cap space, where inefficiencies are more available than, let's say, the large cap space. What are your views on market inefficiencies, and are there certain metrics or qualities in a company that you look for when looking for opportunities?
Great question, and absolutely agree. I think the inefficiencies in the small cap space, I think, are well documented, and I agree with them 100%. So think about it this way. I mean, our goal again is to kind of find that next generation of blue chips, right? And a lot of these companies all started off, the big, large mega caps now all started off as small caps for the most part. So for us, it really is about finding those names. And frankly, we even do screens. We do some screens where we look for ones that aren't followed by Wall Street at all. We kind of like that, right? Kind of, or maybe one or two small firms, but for the most part, we don't like them being covered by Wall Street, because if we could find them and buy them, and then later on when they do get discovered, as you know, that gets more investor interest, and that can be, as long as the company does fundamentally what it should. But in terms of it's interesting in terms of going back to screening, in terms of financial metrics we may be looking at. I mean, I think there's a typical ones you can look at: ROE, debt to cap, ROIC, et cetera. I believe that looking for businesses is not a screen. It's partially a screen, but remember, screens are very limiting, right? You say, okay, give me 10% or higher ROE. Well, what if it's 8% going to 20%, right? So that would eliminate that. So for us, it's more of a building a mosaic approach. So doing some screening, looking at existing holdings, maybe a competitor, supplier, distributor, customer of an existing holding, going to conferences, seeing companies come through. Again, the beauty of the fact that we don't need a lot of names, we can be very discerning in how we're looking for names. Given what you just said, it's amazing how in the Russell 2000 for our small cap product, the Russell 2000s, our benchmark, how much of that majority of that index is basically unprofitable. So you're already taking the ocean and you're fishing from a pretty small pond immediately when you just take out profitability, right? So, which is good for us. So so we can kind of go in and look at some of these companies, and we're actually, yeah, we're looking at the numbers, but we're also looking more at the business and the types of businesses they are, and look at their capital structure, look what they're doing with cash. Are they making a lot of acquisitions? Are they loading up on debt? Are they taking that free cash and maybe buying back shares? So there's all different types of things they can do that get us interested. I mean, that's just really the first very superficial look at these companies. We really get it when we get into all the documents, the 10Ks, Qs, proxy statements, all this kind of stuff. That's when we start digging into the question list. And then when we call the companies, when we really dig in. And again, this goes back to understanding the businesses from the ground up. I could care less about the numbers the next quarter and upper quarters. I want to know why in 5 years this is going to be a good business. And it's going to be a better business, taking market share, gaining competitive advantage, making that competitive moat even deeper and wider. That's really what we're trying to find out structurally about these businesses. And we're not afraid to ask the very simple questions. How do you win business? How do you lose business? We're not there to impress them. We're there to get information. So for us, it's about building that kind of that wall of knowledge over time. And it doesn't just happen after we buy the stock, by the way. I mean, I'm learning about companies we've owned for 15 years. I'm learning new things every day about them, which is it's kind of like life, right? You finish school when supposedly when you graduate college or grad school, whatever. But let's face it, we keep learning until the day we die. So which is what's so great about this job. So all these companies are always teaching us something new. So I guess my long-winded way of saying that we really want to understand these businesses well. And I think that's why for us that leads to that conviction we talked about earlier.
It's such a great point about searching and screening. And, in our industry, financial advisors, a lot of times we may not be screening for individual equity, but in your case, a manager like yourself, right? A small cap manager. And it's important not to be so black and white when looking for maybe the highest Sharpe ratio during a specific time or alpha or, limiting the downside. But look over it a long time. Is it trending upward? Look at the full story, not just that one point in time or maybe the past year, but have you trended upward? And then also not only focus on the quantitative side, but the qualitative side. Who is Jon, right? What is he as a portfolio manager? There's so much more information to find out about a manager than just looking at the Payne ratio or so on. Finding out who you are and believing in the manager as much as just the returns.
I was going to say that's a great point, Ryan. And I think the same way that when we look at businesses, the numbers are great, but the business is generating the numbers, not the other way around. And the same way when people look at managers, right? Like me, you see our numbers, but again, it's our process, who we are, and our philosophy, that create the numbers, right? Not the other way around. So I think looking at a stock like we do is the same thing that people like you look at us.
Yep, fantastic. So let's take a step back and just look more at the small cap space. Small caps have been on a wild ride for investors with, historically a lot of ebbs and flows over time. Currently, small caps are underperforming large caps, and in large part really due, I believe, to the regional banking crisis, as small cap indexes are comprised of a lot of financials. So how should investors view small cap space today? Should it still be a core holding, or, be patient and focus on the long term? What's your view, and how should investors view the small cap space?
Yeah, I think it's important to realize that timing can be everything, right? And I think people get into a certain space or a certain stock at a certain time, and then they're kind of anchored to that. I think, but you have to look at things from a long-term perspective, and I think that's really what we try to do. And I think when it comes to stocks, I think when it comes to small cap space in general, I think you're absolutely right. I think you've seen weakness in the small cap because, remember, in general, the small cap space is more economically sensitive, right? So I think when people are anticipating a recession, as people have been doing, small caps are going to take a little bit larger hit, the same way that when people think the economy is going to be growing, small caps usually lead the way out of the recession, right? And I think that's why you're seeing the weakness here lately with that. I think it's partially the banking, but partially it's, it's that thought of we are going to have a recession. And I think that's really what you have to think about in terms of that. So, but in general, I think the reason I think you have to have a allocation to small cap is because of the growth rate and the opportunity there. And especially, and again, I'm going to make our case again for not only being in a small cap like us, but in that quality area. Because remember, we protect better during a recession, which I think is very, very important. And we do participate on the way up, just maybe not as much as the low quality. But think about small caps as this: the large caps, it goes back to our inefficiency story, right? Large caps, everybody knows them. They're followed by 30 sell side firms. They're already all over global customers all over the world. Small caps are very different. Less Wall Street coverage, maybe 20% exposure to outside the US. So it's really, it's more of a growth opportunity you're going to see. You've got these smaller companies, lower scale in terms of numbers, right? Larger the company, the harder it is to kind of generate large growth. But smaller companies can generate that growth, not only in the US, but also have more of an opportunity outside the US to grow. And again, if you find these companies that can do that with a management team, by the way, that are good stewards of that capital, it's another caveat, we didn't really talk about that. Management teams are huge and very key. This is why we spend a lot of time talking to them. How do they allocate the capital wisely? Because again, great business can go be the best business ever, or it can be driven into the ground by management. So that's why we focus a lot on that. But in small caps, I think that's really important to find those great management teams. So in general, you've got, in my opinion, you have to have an allocation to small cap because of that higher growth and that opportunity. And, we can all try to be market timers. In the end, we all know that's kind of a losing game. But again, if you take that long-term approach, no matter where you enter the market, longer term, the small caps will perform over time.
Fantastic. You mentioned about the economic potential recession moving forward, and I don't want to get compliance involved, but that should bode well for your strategies, right? Quality, trying to protect the downside. But as we know, macro events, particularly monetary policy, has really driven markets since the peak of the pandemic. Are there specific macro events where small caps tend to flourish, like easy monetary policies versus tighter during different inflation regimes? Are there anything that small caps perform better during?
Yeah, absolutely. And you did, Ryan, you just said it. So, when the Fed is being very accommodative, right, and rates are low, remember, we're talking about a lot of these small cap names where a lot of them are very reliant. The lower quality names are very reliant on debt, right? So when they have low debt, they can get that debt and they can grow their business as a result of that. So that's where, in general, smaller caps can do well in the overall market. We have a tendency to, since our companies have less debt, right? So even as interest rates are going up, our companies hold in there better because they don't have to refinance, right? So it really is but remember, the Fed in that time period, when it's being artificially stimulating the economy, I'm more of a laissez-faire type of economist, if you want to call it that, but I believe that the markets need to kind of find their own footing. And by artificially, either raising interest rates or making them real accommodative, you create issues. I mean, there's some people who can argue that the great financial crisis was caused by the years and years before of being the Fed just being very accommodative, right? And they just made it easier for everybody, created this bubble, and next thing you know, we're in trouble here, right? So I think that's why, in general, you can't time things based on what the Fed's going to do. And again, it goes back to, guess what? Fundamentals matter. Quality of the business matters, and what those businesses are producing in terms of financials is what matters. So again, it goes back to timing the market or figuring out what the Fed's going to do. We stay out of that game. Our game is just to find a great business that will do well during good times and bad.
Very interesting. And the Fed creating bubble. I mean, the pandemic, during the peak of the pandemic and the couple of years afterwards, that you could argue that was all supported because of easy money and liquidity and free money, as some people would say. So real quickly, just what are some market risks that keep you up at night? We mentioned kind of the debt ceiling off the table now, but is there any risk moving forward that really worries you?
Yeah, I mean, I think, it's been interesting. I mean, you think about what we've gone through. It's outside of the pandemic, which is enough to talk about on its own. We've had the supply chain issues have been well documented in the last couple of years. Inflation, right? Inflation is something that I've been asking my companies about inflation for over 20 years. And of course, then they look at me and they say, what inflation, right? Well, the last couple of years, oh, here it is. So inflation is something that's really all of a sudden, if you think back far enough, people, a lot of investors, they don't even know what inflation is, and because they weren't around in the 80s. But now you're seeing it, right? And I think this is what, not that I wouldn't say this keep me up at night, because I think our companies can handle this inflation because of the strength of their business, they can pass through pricing enough to offset it. So I think that's very important to know. However, it is something that, it's ongoing, right? Inflation is, if it keeps on going, we are seeing some signs it's mitigating a little bit. But the wage inflation is something that I worry about, right? I mean, it's something that it doesn't just go away. So, you can't just give somebody a 25% raise and then take it away the next year. However, what we are seeing is we're seeing companies lay off people, right? So again, the market is kind of correcting itself, and when it sees a recession coming. So this is why I think the market is, if you just leave it alone, things eventually, work out. So I think for us, I mean, it's always the events I worry about are the ones that you don't know what's going to happen, right? I mean, think about when Russia invaded the Ukraine. I mean, that just came out of nowhere, and it's impacted markets for a long time. As the energy markets got impacted by that, nobody was expecting that. So as far as just like everyday stuff, this is why we invest the way we do, because our companies, we know we won't wake up one morning and find out our company has a liquidity event or just is going to go bankrupt. They're very, very solid businesses, and we are not top-down investors. We're bottom up, but that doesn't mean we don't ignore it in terms of how the top and the macro will impact each of our businesses individually. I think that is something we do.
Awesome. Thank you, Jon. That was fantastic. Such a great conversation about small caps. I love it. So I want to go back to your baseball card collection. Real quickly, we only have a couple minutes left. So,
Sure.
How do you accumulate over 20,000 baseball cards, and where do you store them? I'm fascinated by this baseball card collection.
So the reason that I have 20,000, going back to what you were just talking about, you made a comment about the moms who have the baseball cards hidden for their kids. I'll guarantee you that half of the kids who are my age growing up, half of them, their moms threw out all their baseball cards in the garbage. I have a lot of stories like that. And so my mom never did that. So that's why I think I've accumulated so many, and my mom didn't throw them away. And I have a very large cabinet in my house where I store all of them. I have some in just the boxes that have never been opened, in the cardboard boxes. And I have my coveted ones are in like little plastic sleeves where I look at those. And I was going to say an interesting story. I just, about a couple months ago, there was my brother gave me at a garage sale. He found this big box, and it was filled with all these random baseball cards in it, like just So he just gave them to me, knowing I want them. There were probably about 500-600 in there. So I started looking through them, and I discovered a Ken Griffey Jr. rookie card in there. So, I mean, and these people were just throwing out these cards. So you never know what you're going to find in there. That might be interesting. It's kind of like discovering certain stocks, right? You find one that's great, it ends up being, of course, with the Kayne Griffey, I already did my work on him. I know how great he was, but that's just something that was exciting, and you never know what you're going to get sometimes. But it's another one to add to my collection now.
That's awesome. I don't have nearly 20,000 cards. My mom probably thinks I have 20,000 cards, but I'm very far from that. As a kid growing up, you go to all these baseball card shows and all that stuff.
Yep.
And my gym is a Michael Jordan rookie card, where I was really close to putting it on the market during the pandemic, when baseball cards were going to the moon. But I'm still holding on to it. That's fantastic. And you hear so many stories like that of people in the attic or something finding a Hannes Wagner or some crazy card just collecting dust somewhere. Such a great
Yep.
story. So Jon, thank you so much for joining the show. It was such a great conversation. Learned a lot about small caps. Where can our audience get more information about Kayne Anderson Rudnick and the strategies you manage?
So, I mean, our website it's www.kayne.com, and that's the best way to find us.
Perfect. Awesome, Jon. Thank you again. It was a fantastic conversation. I'd love to have you on again, talk more small caps and in the market that we're in. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts at Adjusted for Risk YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much, and have a great rest of the week.